Check 1, 2. We are live on YouTube, Twitter, Facebook, and we will be going live on TikTok. See if we got any comments here. Okay, nice. Hey, Isaiah, can you check the YouTube stream? See if it's working. Make sure this stuff is working before we get started. It is? You can? You can see my screen? Okay. All right. It doesn't show any viewers yet. I just want to make sure it pops up so I know when somebody's in there. Can you send a comment so I can see if that's working? All right, now it shows 1. There we go. Make sure these comments are working before we get started. Did you send one? All right, nice. Okay, so we got that working from YouTube. All right, sounds good. All right, let's go live on TikTok. All right, we'll go live on TikTok. TikTok, how's it going? How's everything going on TikTok today? We're going to take a look at the market, what's going on today. We're grinding. We sold off in pre-market and now we're sort of grinding higher. And if you want to see my screen, the full screen of the technicals, then go ahead and jump on YouTube live. We're broadcasting on YouTube also, because TikTok, I can't really, you're just going to hear me talking on TikTok. We can't show you the full screen. It doesn't, show the best content. So if you want to jump on our YouTube, there we go. The description the link is in my description in the bio. If you want to see the full screen on what I'm showing. If not, you could just listen to me talk about what we're seeing here with earnings, with the macro data that's rolling in, how the markets are changing. We will react to a couple videos, go over the thesis a little bit, see if the thesis is still intact. Is the bottom end thesis still intact? Can earnings come in better than feared? Right, so that's our thesis right there, is that the bottom is in for the market. There's a lot of indications that show that. So if you want to see the charts, I'm going to be showing the charts on YouTube live. You can see all the charts that I bring up on there. So if you want, switch over there. If not, I'll just go ahead and start talking. Right, so we're going to do that. So right now we're looking at the S&P. Hope everybody's doing good. Right now we're looking at the S&P. Okay. And so far we've had a couple earnings. Let's go over the earnings this week. Charles Schwab had earnings. They beat, and really our thesis is, hey, the lows are in. Okay, the lows are in. Aggressive cost cutting for tech and for, there's a rolling recession going on, and we think the lows are in. We think the October lows are in. If you are on YouTube, let me zoom out so we can kind of see what I mean by the lows. Here we go, 348. That was on SPY. That was the low, and we are trending higher. We are in a bull market. Well, the bull market is not confirmed, but we are trending higher. We are making our way. We're grinding our way between consolidation and a bull market. So really, the question is, are earnings going to come in better than feared? That is the question. Will earnings come in better than feared? All right. And so far, let's go over some of the earnings here. Starting Monday, Charles Schwab beats consensus. Okay. Now the revenue, and we're not going to go through all the details like the profit margins and all that, but just EPS, right? Charles Schwab beats EPS 93 cents EPS, 90 cents consensus. And we're just going over the big ones. Bank of America beat big. Bank of America 94 cents. Okay, so better than feared earnings, and we still have a lot of earnings to go, so it's not over yet. We could get some bad earnings, of course. And we'll talk about what I think of what could really turn the market as far as earnings coming in bad. Netflix beats 288. They made 288. Consensus was 286. Okay, so Netflix beat, and we talked about Netflix yesterday. Netflix, I don't know what Netflix stocks look like. It looks like let's take a look real quick. All right, so Netflix is bouncing. It did sell off, but it is bouncing. Big bounce. Actually, that's a big bounce today. So Netflix is from the lows. Okay, now remember yesterday, well, Tuesday was Netflix's earnings, but it did sell off after earnings, right? It sold off. It bottomed at 316, and we're just sort of talking through this right now. Netflix is up 3.5%, so it bottomed at 318. It's at 330. Join us on YouTube if you want to see live again the actual charts. Link inside of the bio, right? So my whole point is here that I want to look at is how many of these companies are starting to beat, right, versus estimates. And if we do get this consistently happening, then this thesis starts to play out. And we're going to track this day by day because obviously it takes a while. You're not just going to know our earnings better than expected. We got to track that. If the evidence shows otherwise, then the evidence shows otherwise. But right now, Bank of America beat Johnson & Johnson beat pretty well. 268 versus 250 expected. Netflix beat. Lockheed Martin beat. Goldman Sachs beat. I know they had bad earnings, though. They missed on something, but Goldman Sachs beat EPS. All right. Tesla right on course. Tesla came in at 85 cents. A lot of people call it that they missed EPS, but they didn't. They revised it to 86. The consensus was 86 cents. It was revised up to 86 cents. So Tesla's right on course, right? They're cost cutting. So Tesla is cost cutting, right? We see that Tesla's cost cutting. And the argument is, okay, well, Tesla's cost cutting and their margins are terrible. Their margins was bad. They dropped to like 18%, 19%. But you got to think about Tesla. They're cost cutting. They're bringing demand into the market, right? We're looking forward. We're not just looking now. We're looking forward. So they're bringing demand into the market by cost cutting. They're already one of the best selling cars. Model Y is going to be down to some 20 something thousand for a Model Y. They're cost cutting aggressively. I think it was a 29% decline in the price of the Model Y just this year alone. So, yeah, margins aren't going to be great. We're headed into recession if we're not already in a rolling recession. But hey, demand is going to pick up as liquidity comes back into the market, as things start to change if you're a long-term investor, right? So the question, again, we're looking at earnings here. What is it looking like? What is that picture looking like? So Tesla beats, a lot of these companies so far are beating pretty well. They're doing pretty good. The big ones, especially Philip Morris, beat a little bit. Okay, not bad. So we're going to come through again. If you can't see the charts, we are on YouTube Live. We're going to go over sort of the thesis, sort of what it looks like. And so those are the earnings. Real quick, economic data for this week. This was really interesting. There's, a lot of people, not just a lot of people, but nobody knows. Are we in a recession, right? Let me know. Do you think we're in a recession? Are we in a recession? Are we, is this a rolling recession? Or have we not even seen the real recession yet? Okay, that is the question. And me personally, I think we might be in a rolling recession. We've seen a lot of stuff come down in obviously real estate, housing is in a recession. That's pretty obvious. Financials, you could argue, are in a recession. So I think I found some evidence here, especially in manufacturing. Manufacturing goods are definitely in a recession. We've seen that from a lot of the ISM or the manufacturing indexes measured by the Fed. And those are forward-looking economic indicators because they're telling us new orders. They're telling us the new deliveries. They're giving us insight on prices paid, right? All that stuff that precedes the actual economy. How much demand is coming in? How much are they paying for prices when it comes to these businesses in these different regions? Earlier in the week, we got the New York manufacturing. Now I'm going to throw this up on YouTube. Let's throw this up on YouTube real quick so we can see it. Okay. Throw this up on YouTube. And what we're going to look at is the New York me see if I can get this working correctly. We got the New York Fed, basically the New York Empire State Manufacturing Index, and it recovered. It did recover. So that was big news right there. Actually, let me switch this window real quick. We will be going through the economic data first before we hit the charts. All right, so this should be it right here. It's the first time we're streaming on YouTube too, so I'd appreciate if you guys jump over there, hit the likes if you can. If we bring you value on a consistent basis, if you're new, we cover the macro, the technicals, the sentiment, and we have a full thesis that we're going to go over. And we're going to check that thesis each week to see if it's still in line. Okay, right now we see a change in manufacturing, though. We're seeing a change happen in manufacturing. So if you're on YouTube, then you'll be able to see this chart. Again, if not, you can just listen to me to describe this chart. So manufacturing's been in negative territory for a while. The Fed Manufacturing Index from the New York Empire, so from the New York region, has been negative. It's been in recession territory since 20. It's been in recession territory for about 6 to 12 months, right? Back and forth, but it's been below zero, and that really just kind of lends to the fact that the economy is slowing down and that we're in this recession. Some people feel it, some people don't, right? But it recovered above zero for the first time. We are now in expansion territory from the Fed Manufacturing Index in the New York region. So there's multiple regions. On the other hand, right? On the other hand, we see the Philadelphia Fed Manufacturing Index for April. Obviously, these are the April prints, fall into deeper recession territory. So manufacturing leads the services when it comes to the economic cycle, right? Services are 70% of the economy, but manufacturing leads. And there's a lot of reasons for that. We're not going to go through it. But what I'm seeing here is that, okay, in the New York region, there's a recovery happening. And a lot of that might have to do with the fiscal stimulus that we talked about yesterday, that we've been talking about, the fiscal stimulus, the infrastructure bill, okay, coming into play. That's $1 trillion. The Inflation Reduction Act, we don't know how much of that is playing itself out. And the CHIPS Act, right? So where is the recovery happening if we are having one? And where is it falling apart? Where are things falling apart? So the Fed manufacturing, for Philadelphia is falling apart, and that kind of confirms that rolling recession that we were speaking about. Now let's go back to the charts. We're going to go back to the charts. We're going to look at, actually, you know what? Let's go through some more of that data. China is recovering. Just so you guys know, we talked about global liquidity yesterday. China is recovering. Their GDP growth rate beat expectations by 0.5%. That's huge. Industrial production is up. Retail sales are up. And that lends to this earnings, like those multinational companies, right? Those companies that are multinational, they're going to benefit from China's liquidity cycle starting to pick up, their economic cycle starting to pick up. They're going to benefit from that. And we see that Japan is also stimulating. We talked about that yesterday. The liquidity cycle in the globe is picking up, even though the credit crunch or things are slowing in the US economy. Markets feed off of global capital, global liquidity. And we're seeing that come in China, and China leads everything else. So China's basically growing. That's basically the premise there. Okay, now housing is starting to roll over a little more. I know interest rates came back up, and I think bond yields rolled up the last week. Why did bond yields come up? There was something that came out that influenced bond yields come up, which is the cost of capital. And so mortgage demand is still suffering. Building permits are down. So there's not a whole lot of building happening. And, it looked like housing was bottoming, but now it looks like housing is going to start rolling over again because rates are just too high. Rates are too high. And we also know the credit crunch, or there's a lot of defaults happening in commercial real estate. So that's going to impact that whole sector. And as a matter of fact, we do have a section on that we wanted to talk about, where the commercial real estate was falling apart. And let me see, I think it's on this. If you are on YouTube, we can actually see that it was like 3 defaults that have been happening. And here it is. So you guys have probably heard of this. Brookfield reportedly defaulted on one second major office portfolio. And so I believe Brookfield is in Los Angeles and within the metro area. So we got that happening. Okay, that's a big default. 161 million default. Columbia Property Trust defaults on 1.72 billion. So we're getting these defaults happening in real estate. Okay, it is commercial real estate right now, but that's going to leak into the banks. That's going to hurt the banks a little bit, confirming that things are slowing. Okay, things are slowing down. So the housing market looks like it still has room to fall. That's basically what we're looking at. The housing market is showing that it still has room to fall. Mortgage applications declined by 8.8%. Refinancing dropped. Okay, refinancing dropped, and 30-year mortgages are just elevated, so it's pretty negative. So that is it for the economic data so far. Other than, there's nothing too important. I think we get a lot of stuff. Let me see. Today we had the manufacturing. Tomorrow we get S&P PMIs, manufacturing services. Okay, that comes in. We'll see if the economy is weakening, strengthening. But the whole point is are the PMIs going to recover because of China demand? That Chinese demand coming in, it's going to ask, or it's going to cause more demand to come in the market for technology, for certain things. And the question is, does that roll over into the US economy and keep growth from completely collapsing? Right now, let's move over to let's go ahead and get to the charts. That's what I wanted to go over, the charts. Bear with me. If you are on YouTube, this is the first time we're streaming on YouTube. So give us a like if you're on there. All right, let's see how this works. The market is pretty strong though right now. If we just look at the day, so we're going to zoom in on the day, intraday, or the past couple days from earnings. And 410. So we bottomed pre-market at 410. S&P is up for the day, 0.6%. Nothing huge, but we're consolidating. So if you're watching this chart, we are consolidating, regardless of the bad news, or if you want to say Tesla earnings were terrible. They beat on revenue and they beat on EPS, or they were right in line with EPS. Their margins are contracting. Well, that's not a surprise. Okay, that is not a surprise. Margins are going to contract. If you think the market hasn't priced in margin contraction, then the market's a forward-looking mechanism. The question is, has it priced in, how bad can those margin contractions be? Are they going to be worse than expected or better than expected? We know they're going to be negative, or they're going to decline. The question is, are they going to be worse than we actually expect? So that's kind of what we're looking at when it comes to earnings, better or worse than expected. So now going to the S&P charts. Okay, we're going to look at the technicals on the S&P. All right, so in the first part here, we have the day. Now, let's go over the thesis real quick. If you haven't heard sort of the thesis, then we're going to go over that. And we're going to talk about why the bottom is in for the market so far. Now, we can have a pullback. We can definitely have a pullback, but there's a lot of reasons to suggest that the bottom is definitely in, and we either move sideways or we grind higher and we get above that 4,200 level on the S&P. All right. So first, this is on the left side, we have the S&P 500 daily chart, right? Now, if we zoom in here, we see that we are breaking the bear market trend. That is a technical correlation that we're above, and that's on all three of these charts that we see on here. We're breaking that trend. So we broke that trend, which is the bear market trend. That's a technical telling us, hey, we're moving higher, momentum is starting to shift. And we bottomed right on that trend. We made a lower high. I'm sorry, we made a higher low. So we are showing support on that trend. We also see, if we zoom in here, the 50-day moving average crossing above the 200 daily moving average. Right now, that is momentum to the upside. That's a golden cross. Alone, it doesn't mean the market's going higher. There's always some exogenous event that could happen. But for now, as we're tracking it, there's a lot more momentum to the upside in the market, and that's what we're seeing. Okay. Now, moving over to the weekly chart, it's the same thing. We have the S&P above the 50 and the 200. There's no golden cross, but it is holding those moving averages. And we know institutions like to buy above the moving averages. So I think we do get a pullback if earnings are just average. We want to see better than expected, or better than feared. So we can get a pullback back to that $4,000, that 4,000 level. That 4,000 level is sort of where I think we stay bullish. If we do pull back, that would mean that we made a higher low, right? If things are worse, I think we just pull back to the bottom of the range, and we trade sideways from 3,800 to 4,200. But Point being, we're above the 50 and the 200 on the weekly chart and on the daily chart. If we move to the quarterly moving averages, okay, on the S&P, we have the S&P, we have these averages actually turning higher. The slope is pointing up, and we have not seen this the entire bear market. The entire bear market, we have not seen these, and these are quarterly measured weekly averages. So they're measuring the last quarter of price, the last 2 quarters, and the last 3 quarters. Okay, blue is the last quarter, yellow is the last 2 quarters, and red is the last 3 quarters of price action. So they're all, red is not pointing up yet. Red is flat, and this is the best that we've seen so far. And blue is this is the first time blue is actually, the slope is pointing straight up. That's a lot of progress right there. So that's just the S&P. If we switch over to the NASDAQ, then we're going to see that the NASDAQ is even more bullish than the S&P, right? On the left side, NASDAQ is above everything. We see the golden cross. NASDAQ is actually breaking the previous high and holding that level. It's consolidating. And we talked about this. The consolidation above the previous high is another bullish sign. Again, we're just going over the technicals here. And if we look at those quarterly moving averages on the weekly, we can see that the slopes are turning up. All of the slopes are turning up. Blue has crossed, or the last quarter has crossed above the previous 2 quarters. And that's, a pretty bullish trend. Do we pull back? Sure, we can pull back, or we can keep consolidating. But there's a lot of reason to believe that we are still in a bullish trend. Now, here's where the weakness is breadth, okay? S&P equal weight is not as strong as NASDAQ. So we know that. And I think this earnings season pretty much tells us if we're going to get above that level, or if this, if equal weight is going to make a move higher. So far, equal weight is, it's moving sideways, sort of like the S&P, but I think it's a little weaker. It hasn't even got to the top of the previous high. So equal weight is weak. Now, keep in mind when it comes to earnings, the market, I believe, in my opinion, that the market really cares about the largest movers, right? JP Morgan, FANG, it's going to care about those earnings the most because they carry the most weight. So how important is equal weight? Equal weight is important for confirming that we're in a new bull market, but you don't need equal weight moving higher to confirm that the lows are in. All right. So from the big indexes, the lows are showing that the trend is showing that the lows are in, but there's still a lot of weakness in these smaller companies, and they can show, a lot more weakness. If we flip to crypto, okay, Bitcoin is not, it doesn't have earnings, but Bitcoin is pretty bullish. It touched that 30K level. It's getting rejected as we speak. Now the next support is going to be 2,500. If it supports 2,500 and it holds, then I think we make another up move and we come back and test 3,000 or 30,000. That's obvious. But the question here is going to be about earnings. Earnings can push Bitcoin back up, or crypto in general right back up. Okay, now moving to IWM, which is the small caps, the Russell 2000, they seem like they're still in a bearish trend. So again, equal weight is not as strong as NASDAQ or S&P. And I think the reason is big tech carries most of those earnings, regardless of what people say. Big tech's going to be in a washout period for a while. I don't think so. Technology solves problems, right? And if you're going to solve inflation, you need more productivity, and more productivity usually comes from technology solving problems. So that is the key there. All right. So those are the technicals. Let me see if I have any questions here. Oh, I see you on YouTube. Knight, how you doing? We are just going to go, we're pretty much going to go over a thesis in a second here. We're going to go over a thesis and see if it's still intact. By the way, those of you who've been on here before, we talked about oil. I'm going to throw up the oil chart really quick. Okay, we talked about oil being the biggest risk, and what do we see? We see oil getting rejected by 83.50. Okay, we're seeing that. And that's what I said is, hey, if oil gets above 83.50, that kind of hurts the thesis because it makes inflation a little more stickier, but we are not seeing that. Oil's getting rejected. So, hey, it can change, but it did. If we zoom in here, it's actually below the gap up. So it gapped up and opened at 79. And now we are below 79, filling the gap to the downside. So again, you can always fill that gap and move higher, but I don't see that happening as demand slows. As we see these defaults, as things start to slow down, then that tells me demand is not there. But hey, things could change. Like I said, we want to look day by day. We want to put more and more variables together to tell us what's actually happening there. But right now, what we're seeing on the technicals is that oil can't get above 83. And that's super bullish, especially with the dollar coming down. The dollar is still coming down. That's more upside risk on activity right there as the dollar comes down. So let's jump into the thesis. Okay, let's go through some of these comments. Where do you see S&P 500? I'm thinking 416 calls by tomorrow. By tomorrow, let's look at the S&P again. I think we got to get through earnings. We really got to get through earnings. And S&P it has resistance at 420, but it is grinding higher. It's grinding higher. And I think the big change is going to be earnings that come out. Let's see, this is going to be the deciding factor for S&P. It's going to be the big cap earnings. And those, let me see the calendar. When those big cap earnings come out, let's look at next week. Okay, so, and what is your time frame? If you're talking about S&P, what is your actual time frame? If you're talking about in 1 week, we're not talking about day trading right now. We are talking about during this earning season. Can this earning season take us above 420? Does it take us back to 4,000 where the previous support was? Or does it take us back to 3,800? Or even worse, does it bring us to new lows? I don't think there's a chance right now, unless growth collapses or unless inflation starts to resurge, that it goes back to new lows. I think we can retest 3,800 for sure. We can definitely retest 3,800. But again, that's day to day. We're looking at the data, and the data is coming out weak. The data is still coming out weak. And as long as that data comes out weak, then that's almost good news for the market, because it tells us that the Fed is closer to pausing because of that weakness. The credit contraction is also offering more weakness to the economy. And inflation just needs to get below Fed funds, right? Everybody thinks the Fed wants to just keep hiking. They're going to give you those expectations, but they're going to pause. I thought they would pause in May, but and we don't know yet. We still have 2 weeks, right? Right now, the market, though, this is what you guys need to understand. The market, as strong as it is, as strong as we're seeing the market right now, okay, and it's showing strength, right? Technically, it is showing strength. It's pricing another rate hike, 25 basis point rate hike. So it's pricing that in, which would put the upper limit of the Fed funds at 5.25. It put the effective rate, because there's actually three Fed funds. There's the lower limit, the upper limit, and the effective rate. And the effective rate is right in the middle. So that lower limit's at 4.75, 4 3/4, right? It's going to take it to 5. And I'm sorry, it's going to take it. Actually, it's at the lower limit's at 4.75. Yeah, it's at 4.75. Right. Okay. I almost got confused there. It's going to take it to 5, the lower limit to 5. It's going to take the effective rate a little above 5, 5.8, whatever, and the upper limit to 5.25. By the next inflation print, right? I'm betting that we already see PPI below it, that all the inflation prints are going to be below Fed funds, right? And we're in very restrictive territory. I think it was yesterday, Fed Bostic of Atlanta, the Atlanta Fed president, he said one more hike. He believes one more hike and they hold. The market is looking forward to that. The market is looking forward to one more hike and for them to hold, because that signals more liquidity. It's very forward looking. It's not looking right now. It's very forward looking. Okay. So any major catalyst for earnings? I don't know if there's any major catalysts other than, what is revealed from these earnings calls. Are we going to see lower prices or prices coming down? I think the biggest catalyst so far, and I could be wrong, is are companies paying less? And we see that in the PPI. Are companies paying less to create the same revenue, right? Are those prices paid coming down? So I think that's going to be a catalyst for sure. And the dollar plays a role in that for multinational companies. Are they recovering? Is there a rolling recession? But, a lot of companies are still laying off. So that cost cutting could help. I think it's going to help margins for sure. So we don't know. We have to look at the technicals to see what the market says. The market is way smarter than us. Now if it starts showing bearish technicals, then I'm going to question, hey, what is it about what I'm thinking that is wrong? What am I missing? But right now it's in pretty bullish territory. Okay. So it's going to come down to big tech earnings. I think it always comes down to Apple. Apple is $2.5 trillion. How big is Apple? $2.5 trillion, close to $3 trillion in market cap. I mean, that's larger than most of the, most of the small caps. That's pretty much the whole small cap. So it's going to come down to Apple, Microsoft, Google, Amazon to some extent. is the bear market over? Because remember, Apple last earnings call, they had their revenue declined a lot because of the China shutdown. Okay, now keep this in mind. This is another catalyst when it comes to the market. Apple's a lot of the earnings, so that China demand picking up now is only going to boost earnings for Apple, right? And Tesla also. So that's going to bring some demand to earnings. And the question is, hey, have analysts, undershot that or overshot it? If they undershot it and that demand, ramps up, the market could rip higher above that 4,200 just based off Apple's earnings. We don't know though. We got to keep, day by day. We're gonna watch, or we're gonna keep our eye on, the earnings reports, what comes out. I did post Tesla's earnings to some extent, not all the details. There's a lot of details, but so far the main thing is EPS. Are we above EPS or not? All right. So we are gonna go over the thesis. And let me see if you guys have any more comments on TikTok. We don't have a whole lot of people on YouTube. Please hit the likes if we bring you good content. Okay, we have some stuff that has nothing to do with the market in here. If you have any questions, let me know. Let me see. All right. So now again, we're going to start with this thesis. The first thing is, technically, the market is in a bull trend. Okay, the market is in a bull trend. We're making higher lows, right? We're making higher lows. And let me actually zoom this in a little bit. And we're going to go to SPX here. Okay, we're trading in a range, but we're trading in a range, but that range is holding higher each time. It's holding higher. We're almost sort of in a wedge also. So the market's grinding higher. We're above the daily and weekly moving averages. Okay, even if we go to the quarterly moving averages, we're holding those. The slope is starting to change for the first time, and that is a lot of technical bullishness on the market. So we're seeing that happen. And the question is, why is the market so bullish when everybody's so bearish? And even if we look at positioning, and positioning is very bearish, right? Positioning is pretty bearish. So why is that the case? Now let's first start with what is what's been the biggest fear of the market, and that fear of the market has been inflation. Okay, and I think that's part of this is part of the reason the market is trending higher, because regardless of declining earnings, and we'll get to that because the market is forward looking, regardless of declining earnings, inflation is showing a lot of progress. And we got, just like we had Fed Bostic say, hey, we're not done yet, but for the most part, inflation has peaked. I don't think anybody disbelieves that inflation already peaked. Okay, so if you're on YouTube, we're showing the chart. And right here on the left-hand side, this is headline inflation versus Fed funds. And keep this in mind, guys. The Fed just wants to get inflation below the Fed funds effective rate, or below the Fed funds rate. Once it gets under that, we're in restrictive territory, and inflation's only going to go down from there. All right. So right now we have PPI below Fed funds rate. CPI is almost there. It's at 4.99%. PCE is right there. It's a little stickier, right? That's the Fed's preferred inflation gauge. It's a little stickier, but we have another print coming up, and everything else, PPI leads CPI because it is producer prices. And what we think is that producer price index is going to reflect CPI coming lower, PCI coming lower. Now, core inflation is a little stickier. We know that. And, people want to, they want this inflation to be so sticky. They want inflation to be so sticky. They're looking for new lows, right? And if you're a bull, you might be saying, well, I'm a bull, I'm a longer term bull, but I'm looking at the data. And right now, yeah, core inflation looks stickier, but these are very lagging indicators. Shelter is 40%, okay, 30 to 40% of CPI, and it does change a little bit. It does change a little bit, but we do know that shelter is a large part of CPI, okay. And what we see is that shelter is coming down. If we look at Zillow rents, then we know real-time data shows us that CPI is coming down. The price of trade, exports and imports are coming down. That's also coming down. Food and energy is negative right now. Now that might change next month because oil did spike, but food is finally rolling over and energy is in negative territory. Services, super core has been pretty sticky. Also, as the credit crunch takes place, like I'm sure if you go get a haircut, it's probably double of what it was, 2 or 3 years ago. So those super core services will come down eventually. And part of it is shelter, but the other part is that, there's just too much money in the system chasing too much, or I'm sorry, not enough goods, but that's changing. Goods are coming down. People are not paying as much. There is a contraction. We're seeing that in the data. So the only thing you could hang your hat on when it comes to inflation is super core, and everything else is falling. Everything else on a year over year basis is falling lower, and that's what the market wants to see, right? Even Redfin data shows that shelter has been the biggest issue. Redfin data shows us that it's also coming down if we look at that chart. Right now, slipping over to supply side, a lot of that is, this includes supply. That does, I'm sorry, that CPI, core, PPI all include supply side. But if we take a deeper dive, again, looking forward at inflation, because a lot of people believe inflation is going to revamp back up. Well, global supply chain pressure index tells us that there's no more pressure in the supply chains. So take that off the table, right? Labor costs are coming down. Wage growth and average hourly earnings, that's coming down. So we can take that off the table. Can it change? Possibly, but we don't see that happening. Where's it going to change at? Even if we look at ISM prices paid, those things are coming down. Wage pressures are starting to be relieved. The wage pressures are, there's more people coming in the labor force, right? While job openings are falling. So employers do not have to fight or have to hike wages to get people to work again. And that's a good sign for inflation. And that brings us to the next point, which is the end of the hiking cycle. Okay, so if you're watching on YouTube, you can see this. You can see, let me see. Okay, let me read the comment there. Can I see one chart at a time? Hard to see. All right. Well, let's bring this in the middle. See, I'm going to bring this chart up so you can see it a little better. All right, we'll stick with that. So point being, inflation is coming down. All right, inflation is coming down. We see that. And that brings us to the end of the rate hiking cycle. The Fed wants to see, essentially wants to see inflation below the Fed funds rate, right? And we're almost there. We're not there yet, but we're almost there. And as you know, I know there's lag effects when it comes to the rate hikes, and those lag effects are starting to show themselves. The banking crisis, what did it show us? A lot of flight deposits, right? So we had this banking crisis, and I think the banking crisis really is also pointing to the end of the rate hiking cycle, because what happened? We have a banking crisis, deposit flight, and the Fed backstops the system. They come back in, they inject liquidity into these regional banks who are missing deposits, obviously, who could cause a contagion. So they stop the contagion. This is not 2008. The Fed is there to stop it, right? And what does that tell us? That's the end of QT. Not the end, but it's the start of the end of QT, because the Fed is backstopping the system right off the bat. Now, we're not at the very end of QT, but we're at the start of the turn. Okay, we're at the start, and that's what the market is trending higher. That's what it's looking at. And that also, the credit crunch, as we see the credit crunch, that also leans towards a pause, because the credit crunch, as it takes place, as we see more of these commercial real estate defaults happen, right? Brookfield, who else is it? Brookfield, Columbia Property Trust, Blackstone defaulted, and then we're seeing auto loans also happen. There's some defaults in auto loans. We're going to see that. I think there's more pain to come. But if anything gets too, drastic, the Fed's going to step in. Somebody's going to step in. We've seen that. So we'll get the, we'll see the regional bank. We really got to keep our eye on earnings for regional banks and see how bad they got banged up. And, if things are worse than expected and the Fed doesn't do anything, that might change our thesis a little bit. It'll tweak our thesis a little bit. But so far, the Fed is backstopping the system, right? Central banks are now starting to switch. If you look at all the central banks, they're not all, in hiking mode. They're starting to turn. Obviously, the Asian markets, if we look at the Asian region, they're starting to stimulate now, right? India is starting to stimulate. China, Canada is pausing. Australia is pausing. So central banks are kind of leading the Fed. And, just for some information, China always leads the US and the US leads Europe. So Europe is probably going to be the worst shoe to drop. They're probably going to have some more pain, but we're near the end of the rate hiking cycle. And that's part of the reason why the market keeps trending higher. Now, this is an important chart that I really want to look at. Let me see. I got to get this up. We really want to see this because this is a corollary that tells us this is an important correlation. I guess we don't have to. Okay, I guess I could just show it in the notes. All right. So this is important. We talked about this earlier a couple of weeks ago when the ISM PMI came out. So basically, the Fed has always paused, going all the way back to 1950. They've always paused when the ISM here in orange has dropped below 47. 50 is contraction territory. The red is highlighting when the red is highlighting when the ISM dropped below 50 or below 47. I'm sorry, below 47. And the Fed always paused. They either cut rates or they paused, right? Now we are at 46.2. So that just tells us, hey, there's a lot more data leaning towards historically the Fed pausing at this point. I don't think they cut. They're not just going to start cutting because, yeah, inflation's still an issue. But the pause is definitely on the table by looking at this, right? It's on the table. So the interest rate decision is May 3rd. PMIs come out, I think, before that or on the same day. So if that PMI comes in stronger than expected, then definitely they're going to, probably rake 25. Everybody believes they're going to hike 25 basis points. But if they cut, I'm sorry, not if they cut, but if they pause because the ISM comes in weaker than expected, and they have the data beforehand, if the ISM slips even further, that could lean us towards a pause, right? That could lead us toward a pause, given all the other information that we're seeing that could, now the market might rip if it does see a pause. So, that's a lower likelihood that we see that. But, we got to keep in mind as the ISM continues to fall, that is economic growth right there. That is leading economic growth. And that's what the Fed wants to see. It wants to see, that's why it always paused in the past or cut rates. So that's just a probability thing. Okay, now when it comes to risk assets like, NASDAQ or Bitcoin, we know that they price in the Fed's moves beforehand. They're looking at expectations. And the expectation is that they're going to cut at the end of the year and that we are near a pause. So that's another reason why we see markets grinding higher. That doesn't mean we just rip through resistance. We're going to pull back at some point. There's going to be a pullback. And the question is, do we hold the support? Do we hold the next support level? All right. So that brings us next to liquidity. And this is the thing that nobody sees. Nobody is paying attention to this. Liquidity is the tide that lifts all boats. Keep that in mind, right? Global liquidity is picking up. Monetary liquidity is picking up in the globe. And we also have fiscal liquidity that's also picking up. And it starts with China. As I said before, the China credit impulse is the thing that leads the global economy to start turning back up, for the investment cycles to turn back up, right? The PBOC's balance sheet, the Bank of China's balance sheet is turning up. You can see it continuously grinding higher. And I'm gonna practice showing this chart. Let's see if we could bring this chart up. I can mark it up. It'll be a little easier. A lot of tools on here. Okay. I'll get better at this. I'm going to get better at this. But for now, there's just so much data moving around. I really want to show that because a lot of people just give 1 minute sound bites on what's going on. And there's just a lot more information to take in. And I want you guys to have all the data that you need to make an investment decision, or at least your outlook, not just these, half comments or, oh, it's going down because of this or because of that. We got to take everything in consideration and then kind of weigh your options. What are the variables leaning us towards, the next 6 months going down or going up? And again, liquidity is the thing that nobody's looking at. They don't understand liquidity because, and we're going to look at the central bank's balance sheet. That's the thing that pushes markets up. It's like a 97% corollary, right? So global liquidity, China credit impulse turning up. That leads the global economy. We're at the beginning of that cycle happening. China new loans are picking up. Okay. So the new loan volume is just giving us more evidence that China is really stimulating hard. And that takes us to China M2. The money supply of China is going up. And I keep, harping on China because they're the second largest economy. And if you don't think that capital flows into the US equity market or into the crypto market or even to the US Treasury market, then, you haven't done your research, because it flows into capital markets regardless. People are going to take risk where, it best suits them. People are selfish. They don't want to buy, Chinese equities as much as they're going to buy US equities. That's not always the case, don't get me wrong, but we just see that in the data. The biggest companies are in the US. Okay. So China lead. Now, if we look at the four biggest central banks, right, and we look at M2, this is M2 looking at the four biggest central banks. So the Fed, the Public Bank of China, the Bank of Japan, the ECB, European Central Bank. M2 is at the bottom, and this is like a 20-year low. We've made a 20-year low. And what happens every single time that M2 gets to the bottom? Central banks freak out. The collateral is at risk, right? The central bank collateral is at risk. And I don't know why people think that central banks and governments are just going to let everything collapse. They're not. When there's a surprise like 2001, in 08, that's a surprise. That wasn't like, oh, okay, we're headed into recession. Nobody believed that. Right now, this is the most priced in recession ever, because everybody's seen it coming once inflation popped up and we knew we had to tighten the cycle. So everybody sees it coming. No, there's not going to be any, there could be surprises, but we know how the Fed's going to respond to that. They're going to pump more liquidity. And that's why the Fed's balance sheet is turning up. So when we look at these central banks, altogether, the total liquidity coming out of these central banks, it went to a -5, and now it's starting to come up. Does it go straight up? Probably not. But we're at the bottom of the cycle. So that cycle, as it makes its way up over the next 1 to 2 years, that's going to be your best risk reward, or your best correlation to point to, hey, as liquidity picks up, I got to keep in mind that the markets respond to global liquidity picking up in the market. All right. And this takes us to Fed net liquidity. We every time this chart comes out, or there's a new month, we're going to show the liquidity and how it's playing on the market. If you look at it, obviously the S&P and Fed net liquidity is pretty, 1 for 1. Not exactly, obviously, but the market responds to liquidity. That's the point here. Okay. Now, this is the one that I wanted to zoom in on a little bit. If we can, let's see if we could zoom in on this, because this is the Fed's balance sheet versus the S&P kind of long term. And what we're seeing here, actually, that's a big enough picture. If you're on YouTube, you can see it. And what we see here is every time the Fed injects liquidity, right here was 2008 financial crisis. We fell apart. The Fed injects liquidity. It takes a while, but the market recovers. Okay. They inject liquidity again. Here's the second instance. They inject liquidity. The market ramps higher. They pause liquidity and the market falls, right? They pause liquidity, the market falls. They have, it goes sideways. Liquidity goes sideways for a while, and the market struggles. As soon as they start increasing liquidity again, I think this was 2013 to 14, or 2013, somewhere around there, the market just rages higher. So liquidity is pulling the market up. As soon as they pause liquidity, what happens? We get the, I think this was the Chinese, we get a contraction in liquidity basically. And this is the Chinese stock market fall. I think I don't remember what it was, the Chinese stock market crisis, and it was had to do something with oil. Either way, they had to stop pumping liquidity and the market struggled. It moved sideways for a year. Okay, so that liquidity was sideways for a while. Once they started retracting liquidity, now we had a big run up, and we're going to go over that run up. It came from fiscal policy. That came from the Trump tax cuts. Okay. And that that was fiscal liquidity. So we're talking about monetary liquidity. But once fiscal liquidity came into the market, markets moved higher that whole year. But as soon as the Fed started shaving the balance sheet again, started removing that liquidity, the market struggled again. So, I mean, just look at the correlation. These, unless you think that all the data is just false, it's like, wow, okay, well, you can't really show you can't believe anything, right? Now we had COVID or the pandemic crashed everything. The Fed they pumped so much liquidity, the market had the biggest move that it's ever had because of all that liquidity. The market moves off liquidity. Now we're zoomed in here, okay, on the bottom right, we're zoomed in, and we see that the Fed started retracting liquidity in March of 2022, and we've had a bear market. If they kept injecting liquidity, we wouldn't be in a bear market, but they had to, right? It happened. So we're in a bear market for a whole year pretty much. And now we did bounce in October before they actually injected liquidity, and we could have rolled over, but we had the banking crisis. And this is a huge pivot for people, right? A banking crisis should be the end. It should be a rollover in the market, but we didn't get that. We had the Fed inject 450 billion. excuse me, some people say half a trillion, and the market bounced. So, you know, the takeaway here is watch the Fed's balance sheet. And it's not just about the Fed, it's global liquidity. That's why the market can trend higher, right? Or at least not make a new low. I always say that we can come back and test the bottom, but we're not making any new lows. And Bitcoin also attests to liquidity, because we see the liquidity, we see Bitcoin cycles are mostly correlated to liquidity, because as soon as the central banks, the top 5 central banks, and this is Bitcoin versus central bank liquidity year over year, as soon as they retract that liquidity or it draws down, Bitcoin cannot stay any higher. But as soon as they start pumping again, crypto runs up. Well, Bitcoin runs up. We're not going to say all of crypto, right? Okay, so that's sort of the liquidity picture. We just want to keep that in mind, right? And I was talking to a couple dudes, and they said, well, liquidity doesn't, it doesn't matter. That liquidity goes to the banks. They're not buying. They're not speculating. Yes, they are. We don't know exactly what they're doing, but when we see the bank, or when we see the Fed inject liquidity into these banks, guess what? They're doing deals, or not doing deals. I'm sorry. Their money market funds or market makers, they need more liquidity to take risk in the market, and they're going to take risks. That's what they do. They take risks. And that's why the market keeps moving up regardless of inflation, because as the Fed debases the currency, they're also removing the collateral. And I try to keep this in your head. As the Fed increases liquidity, the US dollar, they're debasing the currency. And when you debase the currency, you're reducing the value of the denominator. So what happens to the numerator? The numerator goes up in value automatically, because the numerator is literally the collateral of the system, and they can't let that fail. So they're going to print, and they're going to debase the currency to increase that collateral, so that we don't get another 2008 financial collapse. And that finds its way into capital markets. All right. All right, so we can move over to fiscal liquidity. Fiscal liquidity. So if you're on YouTube, you'll be able to see this. Make sure we got this running right. Now, fiscal liquidity is important too. It's not just about the monetary liquidity, but fiscal liquidity. And we're going to go over how, in 2017, we saw the same thing happen, where I think this is here we go. We saw the same thing in 2017. The Fed, so this is the chart. You guys can see it if you're on YouTube. Basically, the Fed was increasing rates, okay? Bond yields also went up. So interest rates were rising, and the stock market went higher the whole year. That was a huge year in 2016 to 2017, or to the end of 2018. And that was because of the tax cuts. That was fiscal stimulus coming into the market. And fiscal stimulus, and there's a thing though, we're not just going to get fiscal stimulus boosting the markets. You also need to have the dollar falling and the ISM picking back up. So that ISM survey needs to also pick up. You don't just get, fiscal stimulus by itself is not enough variables. So again, let's take a look at what I'm actually saying here, which is, let's go to the next. We're gonna find a faster way to do this. Okay. All right, there we go. So if you're on YouTube, you'll be able to see this chart. Stocks can perform during tight policy when the ISM rises and the dollar eases, right? So at that same time, we saw that interest rates were rising. So, things were tight, just like they are now. And the stock market went higher because of fiscal stimulus. Yeah, we didn't have inflation. Okay, so I get that, but inflation is coming down right now. And basically what you see is, as they tighten, the stock market grinds higher, because the dollar is relieving a lot of that pressure. The dollar is the denominator. So as it falls, it's going to push up asset prices automatically. All right. But you don't just need the dollar falling. You also need the economy to start recovering, not in real time, but through the ISM manufacturing index, through the ISM PMI, because that is a leading indicator to business activity, right? That's the most leading indicator. So we haven't seen that yet. We know the ISM comes out the first week. I'm sorry, the first week of the next month. So May 1st, 2nd, or 3rd, we should see the ISM survey. If it goes lower, we're not recovering yet. So we might just move sideways in the market. That lends to a sideways move in the S&P. But if the ISM survey did bottom, let's say because the New York Empire State Manufacturing Index, it jumped above it jumped into expansion territory. So parts of the economy are recovering while others are sinking further. So we'll see what happens. But either way, once the ISM bottoms, that's always been a signal that the market is about to start ripping up. But the market has already bottomed. That's always a signal there. So we're looking out for the ISM survey to actually bounce. And also remember, the Fed pauses when the ISM drops below 47. So we might have one more hike and then the Fed pauses. And inflation is about to be right under Fed funds. So that's also another variable for the market to grind higher. Now, the biggest risks, like I've said before, I'm not just saying that the market's going to grind higher. The biggest risk are that growth completely collapses. So we do get that collapse in growth, or we see inflation resurge, but we're not seeing inflation resurge. That's not happening anywhere unless oil prices explode, unless, China invades unless China invades Taiwan. That's going to be obviously that's going to be a global risk, right? That's going to be a global risk that might push inflation expectations up and also just cause uncertainty. Now, if that happens, we'll see the dollar spike. We're going to see the dollar spike if China invades Taiwan. That's a risk off. That's just fear of global uncertainty. So I always look at the technicals to see what is actually happening. We see the data, but we're getting the data last. What are the technicals telling us in the market? So if that does happen, that is the risk. China invades Taiwan. The Russian-Ukraine conflict, something changes that we don't expect. Or oil spikes and holds above 83.50, just got rejected. Not happening yet, right? Not happening. Or the Fed, we get a commercial real estate collapse and the Fed doesn't rescue the banking system and lets it crash. The market's going to rip down because the market wants to see the Fed step in. So do we know for sure they're going to do it? No, but our evidence is, hey, the last crisis, they stepped in. So we got to stick with that variable that they're going to step in and fill the holes. And we do know when they fill holes, they're pumping that balance sheet, and that's more monetary stimulus. And we haven't even got to the fiscal stimulus that's actually hitting the economy yet. We haven't even got there yet. So let's get back to the thesis. If you're on YouTube, we're going through the charts we're going through the economic charts. All right. That point to the thesis. Now, what's next on this thesis? Okay, we already went through liquidity. We did not go through fiscal liquidity, right? So let's go through fiscal liquidity if you're on here. All right, so fiscal liquidity this is the chart we're going to look at for fiscal liquidity. I just took a picture of, we can see that. All right, so here's the fiscal liquidity. Obviously, we have global liquidity picking up from China, from Japan, the Fed's balance sheet to some degree. If something breaks, they're going to step up more liquidity. The market that pours into capital markets. But we also have the infrastructure bill, right? We have the infrastructure bill, and that benefits certain companies, construction companies, but it pours into the economy. That's $1 trillion of stimulus, by the way, from the infrastructure bill that goes through 2026. So it's almost a consistent bid of liquidity for the economy or for markets in general. That's a pretty smooth bid there, right? Construction, transportation, technology, energy, materials, utilities. So those are the things receiving a paycheck from the government. And that kind of lends to, hey, economic growth is not going to collapse because this infrastructure bill is still playing its way out or playing itself out into the economy. And that could be why the New York Empire Manufacturing Index actually rose, because it should be collapsing if we're going into this deep economic recession. And it went in expansion territory, right? Next, we have the CHIPS Act. That's $280 billion of stimulus, right? And that's probably why we see NVIDIA and all these other companies explode to the upside, making big moves. Now, they're going to pull back at some point, but there's confidence in those sectors because the government is pouring liquidity, fiscal liquidity into that sector, the CHIPS Act, right? Semiconductors. And semiconductors are going to help with manufacturing, technology, defense, automotive, renewable energy, stuff like that. And then you have the Inflation Reduction Act. And the Inflation Reduction Act, that's a 10-year stimulus. So it's going to go out to it's going to be spread out, but it's $650 billion of liquidity that's going to be spread out. And I think Tesla and Enphase are two companies you can think of that benefit the most from it. Clean energy, renewable energy, EVs, uh, healthcare, but mostly cleaner. A lot of it is about cleaner energy, obviously, to redirect us away from the reliance on oil, which causes war all the time. All right. So we have that fiscal stimulus coming in, and you just got to keep in mind we have all this different liquidity coming into the market, and the market can move off of that, not like straight up to the upside, but it can definitely hold higher or trend sideways because it has reassurance that there's something coming into the market. And we saw the Fed's balance sheet, it's pretty correlated to liquidity. Okay, we're going to switch over to earnings, the earnings picture. And that's kind of what we're looking at now. What are the earnings picture? Tesla came out, margins fell, but we already know that's going to happen. And we knew margins were going to fall. That's not a surprise. The surprise is how bad did they fall and how long does it stay down there? We don't know yet. We just don't know that. But, China's, if we go through the next quarter, we know that China loves, electric vehicles, or they're switching at least, and Tesla's going to benefit from that stimulus in China. So, you have those earnings picking up to some degree. Let me find the earnings picture. If you are on YouTube watching, please hit the likes too. If you guys are on, hit the likes, give us some likes. If you don't mind, let me go through your questions, see if we have any questions here. Okay, it doesn't look like we do. But either way, we're going to go through the earnings picture. So I think this will be the best one. Okay. All right, so here is what we are looking at. Let's see if this thing can. There we go. All right, so this is the earnings picture that we are taking a look at. Let's widen that out. Can earnings come in better than feared? Did I lose a document here? Okay, let me pull that document up. There it is. Okay. All right, so earnings. Now, we know earnings are going to be contracting this year or this quarter. We did last quarter. So we think, hey, earnings are going to be, earnings are definitely declining. We're in an earnings recession. But there's a possibility that earnings can be better than feared for a couple of reasons. First, aggressive cost cutting. And I think this is the biggest part. And everybody wondered, why did the market bounce in October when it knows earnings are going to get, degrade even further? Because it's hard to hire people, but it's easy to fire. And once you start cutting, payrolls, you're going to automatically just pump your margins, period. Now, revenues, go up over time, and inflation's falling at the same time. So when you cut, when you cost cut, and it's not just, layoffs, it's also not paying for certain things like Netflix. Netflix basically said, hey, we're not going to produce as much content anymore. And the investors like that because they're cutting their costs, right? They're just going to produce quality content. And that's good because we kind of need that. We need better productivity, not just, irresponsible spending to get any revenue you can. So they're cutting their costs, right? A lot of companies are cutting costs, and whether it's layoffs or not. And that is one reason that earnings can be better than feared. Now, does it last? How long does it last? I don't know. We just don't know. We got to see the earnings reports. But at the same time, producer prices are falling. So for those producers, producer price inflation is coming down. That improves margins also. So the consumer is still paying for that, and this consumer is going to pull back. So, there's going to be less, but the market really just cares about margins, and it cares about EPS and earnings and all that stuff. So producer prices are coming down. We see that. Now, the other part is that a lot of people are not familiar with is, a lot of earnings are the biggest companies, the multinationals. So Apple, Tesla, Microsoft, whoever's a multinational company in other countries, they're going to benefit from a dollar falling or depreciating, a weakening dollar. And the reason why they benefit from a weakening dollar is because there's this thing called FX pressure, and it's the exchange of currency. As the dollar falls in value, the currencies of these other countries increase in value. Therefore, the products are going to be cheaper. And that doesn't mean somebody's like, oh, it's 60 cents cheaper, we're going to buy it. It just means overall that demand is going to pick up, and the cost of labor is also cheaper for multinationals. And as they convert their earnings into US dollars, it's also going to pump those earnings. So FX pressures from the dollar falling is going to help multinational companies, not all companies, but multinationals. And we know Apple is going to swing a big part of, or is a big part of the S&P earnings, and some of these other big companies. So we'll see how that plays on effect. We'll have to just wait for the earnings. The other part is, as the economy slows down, yields fall. So you have lower rates. And if we have lower rates, that's pumping valuations. Okay. And we already know we have fiscal and, global liquidity coming into the market that may not have been discounted. Maybe it has, who knows? Maybe the market has discounted it. But either way, we have that on, coming in. So the next part is really, equities have typically bottomed 6 to 9 months before earnings reach their low. I've talked about this multiple times, and I'm just going to keep highlighting that the equity market is going to bottom way before earnings actually bottom. This is not abnormal. This is a normal thing. So if you are on YouTube, you can see this chart right here. Let me see if I can make it a little clear. There we go. And if you guys want to, please subscribe on YouTube. It's in the bio if you guys want to see the live feed of the actual charts that I'm showing up here. And so what we're looking at here is basically the October lows. If we use this chart, right, this is just a model. So if we use this chart, the October lows are basically at the zero bound. But if we look 6 months out, and we say 6 months is, the average between 6 and 9 months where earnings can bottom and the market still grinds higher, then 6 months would make April, this earnings season. It would mean that we could still be grinding higher, or it wouldn't be abnormal for the market to still move higher, although earnings are declining, and although earnings, bottom. We really need earnings to bottom. We don't know if they bottomed yet, but again, we're taking a probability guess off of all the stuff that we've already talked about. And I think the big one is the liquidity cycle starting to pick up. If that's the bottom, then it's not abnormal that the market can see earnings literally keep going lower in April and still continue higher, right? Now, if the average is 6 to 9 months, then we can go all the way out to July and still say, okay, there's a high probability that the market keeps going higher, just because obviously it's forward looking, it's looking into the future, and it discounts negative earnings or earnings recession 6 to 9 months beforehand. In some cases, 12 months, right? Now, if we actually go through the history, because it's, what's the point of looking at that unless you actually see real use cases? And that's what we're going to do, is kind of look at this history to see how this actually works. So we're going to zoom in here. And first, we're going to look at 1950. What is this? 1957. So in 1957, the blue dot is S&P 500. S&P 500 bottomed well before earnings. Earnings didn't bottom till almost a year later, right? So almost a year later, the S&P bottomed. So there's your first example. Number two, we're going to move on to the 1970s, and this was stagflation. So you could compare that to today. S&P bottomed, well, it double bottomed, and we saw the market bottom at the same time earnings actually peaked. So earnings fell for about 9 months before. So this was like 9 months beforehand. Earnings fell for 9 months while the market had already bottomed, right? So that would match July. If we go out from October to July, we can see earnings decline into July, and that would match this 1970 stagflation era. All right. Now we go to the 1980s. Okay, so the 1980s we see the market bottom 4 to 6 months before earnings bottom. There's another example, and this was marked by the double dip recession. Okay, and that had something to do with the overseas uncertainty. The S&L crisis, 1990s. We're just going to move through this really quick. The market bottom 12 months before earnings. Okay, so again, another example of the market bottoming way beforehand. And 12 months would mean that if we compare this to October, right, or this year, we could have earnings decline all the way till October, and the market still runs higher. The market's still moving up. So again, we need inflation to come down. We need the Fed to pivot. So it's not just going to move up or bottom, but we need that, and that's what it's looking at. And we've already talked about that. But this is a metric just to look at. Hey, it's not abnormal that the market bottoms way before earnings. We moved to 1999. Okay, now this was the dot-com bubble. This was the case where it didn't happen. Okay, this did not match. Now you can go with the exception and say that we're similar to the dot-com bubble. That's fine, but I'm going to stick with the probabilities and mark that as on my calendar as a variable, not the opposite. I'm going to use the higher probability as a variable, not the exception as a variable, unless it's super similar. But I don't think it's as similar as what we're seeing right now. I don't think we're as similar to the dot-com bubble. All right. So the financial crisis, obviously 2008, and we saw the same thing. The market bottomed 6 months before earnings bottomed. And okay, so that's 6 months. So that would put us right now in April. We can still, earnings can bottom in April. The market still goes higher. It's not abnormal. The next we have the 2020. Obviously, the pandemic. The pandemic was terrible. Now this was a little outlier, but the same correlation happened. We peaked 9 months before earnings actually bottomed. Or I'm sorry, we peaked. We bottomed 9 months before earnings bottomed. So there you go again. So all those instances, 6 out of 7 times, 6 out of 7 bear markets, the market bottomed either 6 to 9 months, in some cases 12, in other cases 4, before earnings actually bottomed. And that's kind of what we're looking at is, hey, that's not abnormal for us to see that. So we're keeping our eye on earnings. I think if we see the bottom of earnings, how would we know that? We don't really know, but the market is very forward looking. That's what the market is looking at, is can we price in the end of the bottom of earnings? And what gives us confidence that that is the bottom of earnings? Well, fiscal stimulus and global liquidity picking up, and eventually that cycle is going to change. All right, so next on the thesis is, it's kind of, if you're on YouTube, I got to get used to this switching windows. We'll get a little more efficient as stuff comes out. So next we have everybody's favorite, and we're going to go over a video on this. We're going to do a video on this one. This is about positioning. This is all about positioning. But before we do that, please hit the like button. Please hit the likes if we're bringing you some value. We're going to go over that. I'm going to take a slight break and we're going to come back. We're actually going to listen to a video. I'm going to react to it because positioning is the thing everybody's hot about. Everybody, oh my God, positioning is negative. There's going to be a short squeeze, or some people are saying, well, positioning is negative because they're right. So we're going to go over that. Hit the likes though. I'll be right back. And we're going to go over positioning and how positioning sets up a potential short squeeze. And there's a lot of history behind that. We'll be right back. And we're back. We're back. So we're going to go over positioning. And in order to do that, we're going to pull up a clip. Some of you guys there, you're going to just have to listen to the clip. I'll pause it and go over it, but we're definitely going to go over that clip and see how positioning plays its way into this. All right, so let's choose. Let's go with this one. Hopefully our volume works pretty good. Switch this on YouTube. There we go. All right. So if you're on YouTube, you can see that screen. We're going to play this clip. We'll also go over the bear market case. We have a couple of bear market guys, and we'll talk about, where they're right at, where they're wrong. But first, let's go over this positioning. So we just made this clip yesterday.
Investors refuse to believe it. You asked me what's the number one most bullish factor. It's how bearish everyone is. Bears reload on equity shorts, net short position, and E-mini futures at the highest level since 2011. Like, we've been in rally mode, and they're shorting more heavily into it. Actual price action is following some of the oldest investment cliches in the book. Never short new highs or buy new lows. Valuation is just a number. JP Morgan did this.
Okay, so that first part is okay. There's obviously a 13-year high of net negative positioning, and we have, what is it, CTFC aggregate net speculative positioning in U.S. Treasuries and S&P 500 is at like I would say the U.S. Treasury positioning negative is at a 20-year low, and the S&P is 13. So you have a large amount of people, or not just people, but fund managers, institutional investors, very negative on treasuries, very negative on S&P. All right. And one of the rules to investing or even trading is do not short new highs. Intraday is different, but don't short new highs and don't buy new lows, because it can rip against you. That's just one of the rules. And that's all they're talking about there. The more interesting thing is that the sentiment is so strong to the downside, and that's usually marks the bottom. There was a tweet by Tom Lee or somebody else who showed it. And whenever there's, this many people, there was one time that negative positioning was this, or positioning was this negative, and it resulted in a bear market, and that was 2008. So you'd have to say, okay, the other instances that marked the bottom. So, hey, are we in an 08 crisis, or, are we looking at 08 possibly? I don't think so. I don't think so. There's the Fed knows the issues of 08. There was a whole lot of negativity, not negativity. There's a whole lot of plumbing that went wrong in 08. We know what's going on right now. We know there's a commercial real estate crisis. We know inflation is the issue. We're fighting inflation. It's happening. The Fed's already stepping in when we get a banking crisis. Those type of things are working their way out. So there's no surprises yet. Could there be a surprise? Sure. But we're not seeing any surprises yet. Now, if there is some type of surprise, then we come back to the table and we reevaluate, we reassess. Okay, maybe we will trade sideways for the next 6 to 12 months. Maybe we do go and reach new lows, but right now the evidence is not there. All right. So second part of this was, we'll listen to the second part.
Where do you see S&P 500 at year end? 13% said below 3,500. 54% said 3,500. Stocks fall when you get a recession. Well, actually, no. Stocks fall in anticipation of recession. Guess what? They did. So now maybe stocks are looking forward to the recovery or a modest recession. Here's another one from JP Morgan. Are you more likely to increase or decrease?
So that last one was basically, and I think it's, let me find it on here. I think I have it somewhere. The positioning. Where's the net negative positioning on this slide? It was basically, 54% of respondents, and who's JP Morgan actually asking questions to? Probably institutional investors. Who knows? I don't know exactly, but whoever they're asking, they're all expecting year-end S&P to be below 3,500. So to make new lows. So many people are betting on S&P being below, 3,500. That means Bitcoin also goes and retests the lows, because obviously that's, it's going to affect everything. So A lot of people are negative, and when you get that many people negative, it usually results in the I'm sorry, excuse me. It results in the end of the downside, right? Except for one instance, 2008. And this was also, what is this? Large spec positioning. If you are, okay, you can't see it on YouTube. Large spec positioning also showed 1, 2, 3, 4, 5 times, 4 times that when positioning was this negative. So this was near 2020, probably in March. This was 2019. This was the end of 2015, early 2016, and this was 2011. Every single time that we got this negative in speculative positioning, whoever those people are, the market bounced. And we've already, NASDAQ is down. It was down 37%. So people want that 50% drawdown. It years ago, you could get a 50% drawdown. There wasn't that much collateral, but now the market is so ginormous. 37% is still much bigger than it was at 50% in the past. That's a lot of money that already drained out of the system. And so, I don't know. I mean, hey, we could turn lower, but we're just looking at the positioning and how sentiment can create a bull market, because all these people are standing on the sideline. There's no selling pressure. They're waiting. How many people are shorting and how many people are just waiting for things to drop? So the second part is, are you more likely to increase or decrease equity exposure over the coming days or week? Let me hear it out first. Let's listen to it.
Equity exposure over the coming days, weeks. I mean, holy shit. The lowest buy reading in its 17-year history. So bullet. Okay, so the lowest buy reading in 17-year history. This is JP Morgan. If you don't trust their research, you don't trust everything, but either way, it does show you sentiment when it comes to these institutional investors is to the downside, very much to the downside. So that's another reason why, if earnings come in better than expected, we could see that capitulation from those institutions, especially we're near the end. There was also another, what was it? There was another, what was it? It was can't remember what it was. I think it was a questionnaire, and it asked, what would you do? That's what it was. What would you do, or what would make you bullish on the market? And 50% of those respondents said inflation below Fed funds and the Fed pausing. I'm like, wow, we're right there. We're right around that corner from the Fed pausing and from inflation getting below Fed funds. May, June, July. And the highest print in inflation was June. It was last June. So we're probably going to see the lowest print coming up in the next couple months. So I think people capitulate. I think we're going to get a capitulation. Now, does the market trend sideways at these highs before that? Maybe not. But either way, once that capitulation happens, if those people are actually bullish, then we're pretty close to things starting to turn. All right, now let's listen to, and the whole point here is just, when you're that negative, it reduces selling pressure. Okay, there's a lot of people in cash waiting. You might be one of those people, and that's totally fine if you're waiting. Don't take a risk if you don't believe in something. But when things move in the market, they move pretty quick. So we'll see. Our earnings going to come in better than expected, or at least not worse, better than feared, because there's a lot of fear on earnings and margins compressing. But as we showed earlier, the market usually bottoms before earnings actually bottom, 6 to 9 months beforehand. So let's go ahead and look at now this bear. We will see a 10% correction. He makes some good points. I actually don't disagree with him on everything. So let's go through that. Now, if you are on let's see, TikTok, maybe I'm gonna switch the screen. Let me see if this works. Yeah, I'm gonna switch the screen so you guys can at least see this. There we go, flip camera. Okay. And I'll just talk through it here. You can see it if you're on YouTube.
May and go away. Expect a 10% correction in the next 4 May and go away. Expect a 10% correction in the next 3 to 6 months. we're going to have a correction. We expect a pullback over the next 3-6 months, whether it's related to banks, whether it's related to the Fed, or whether it's related to multiples compressing. The risk reward.
Okay, real quick, whether it's related to banks. Okay, well, all right. So we had a banking crisis. We had SVB collapse to some degree. We had First Republic. We had multiple banks have issues. And what actually happened is the Fed stepped in and the market ended up going higher because they injected liquidity. So the market doesn't care if there's, banking problems. It already knows that there's going to be banking problems. The market wants to know certainty, wants to have certainty that the Fed will step in or the US Treasury will step in, the FDIC will step in and actually cover those deposits or cover those banking issues. So as long as it's sure about that, we already have evidence that the market can move higher if we see those issues. Now, margins compressing, yes, that is a question. If margins compress too much, then we can reprice, but I don't think we make new lows. We'll continue.
This does not look that attractive. What do you think this rally is about? What if the worst that was going to happen happened? What if somehow we actually have a soft landing? So what we're expecting is a Bible pullback. We think it's around 10%. We think you get the 3,700. We're going to get multiple compression.
No, these are the bears changing their narrative. First, it was we're making new lows. We're going to break 3,500s. Now the bears are saying we're going to have a Bible pullback to the bottom of the range. Okay, well, that's not a bear market. You're going to pull back to 3,700, which is literally the bottom of the S&P range where it broke out of the bear market trend. All it's doing is confirming the bottom of that trend. So I could see that happening. We get worse than expected earnings. The Fed holds a little higher than longer. Inflation is a little stickier. We come back down. That's not super bearish. That's just a correction. So again, this guy he was a lot more negative beforehand. Beforehand, he was saying we're making new lows. Now he's changing up his narrative. And I'm telling you guys, these guys are changing up their narrative because they see that there's a lot more upside coming into the market. The CHIPS Act, the Inflation Reduction Act, not that those weren't there already, but now they're playing themselves out in the economy. So maybe things aren't as bad as we think. We have producer prices also coming down. So they're changing their narrative slightly, and that's okay. You got to adjust to it. That's why I said I don't disagree. If something bad happens or if things, kind of fall worse than we expect, we could go back and test 3,800. He's saying 37 like a new low, but support is at 38. So that's pretty much what I think about that part. Let's keep going, see what he says.
The market's going to start to say, oh, wait a minute, we didn't think about this. We're at the end of the cycle. We're going to get a blip because of SVB. And we had a banking crisis that never leads to more credit availability. And if banks don't make financial conditions tighter, then the Fed will. So it doesn't matter what happens, because if the Fed says, hey, the banking situation is fine, they're going to tighten even more. Our price target is 4,200. That's still your end of your target. Sell before May and go away.
All right. He said a couple things. Hold on.
More credit availability. And if banks don't make financial conditions tighter, then the Fed will. All
right. So if banks don't make things tighter, well, they are making things tighter. We're seeing, banking standards actually increase. We're seeing C&I loans, right? Commercial and industrial loans actually tighten the economy. So it's already happening. We're seeing that. That's why we get those commercial real estate defaults starting to happen. So that is already happening. The market has already priced that in. And I don't think banks are going to turn around and start lending, aggressively anytime soon. I don't see that happening.
Doesn't matter what happens, because if the Fed says, hey, the banking situation is fine, they're going to tighten even more. Our price target is 4,200. That's still your end of your target.
Okay, so he basically just thinks we move sideways and then we end at 4,200. I guess you can call that a bear market, and that's totally fine. But I think my biggest disagreement with him is that the market hasn't priced in the pain that he's talking about. The biggest one is going to be the margin compression. So do margins compress to the degree that the market has not actually priced in yet? And remember, we talked about the aggressive cost cutting. Well, the aggressive cost cutting and the falling dollar and the fiscal stimulus and the global stimulus coming from China and Japan could offset those margins, especially in the big companies like Apple and Tesla and the other multinationals. So we're wait and see. We'll see what actually happens there. Now let's go to Tom Lee. Okay. And he says a whole lot of things here. Let's listen to and react to that.
Market ends when the market doesn't go down on bad news. We've had a string of bad news for the last 6 months, and the stock market is almost 20% higher. If you look at 2-year stack,
okay, so yeah, we have bad news coming into the market, as in growth is falling, and the market actually likes that. When we see payrolls declining or, you know, retail sales declining, the market didn't fall. So what does that tell you as growth comes in, you know, pretty bad, or it's declining, growth is slowing, so bad news, we're getting that type of bad news. And inflation is not bad news. It's not, inflation is trending lower. We would have to see an uptick in inflation for that to be, you know, I think that's the real bad news if we get an uptick in inflation, but we don't see that happening anywhere unless oil breaks out, as we said before. So going back to it, the market is seeing bad news, which is, you know, retail sales. What else would it be? ISM manufacturing, the PMIs are falling. So all this growth is falling apart and the market is not, because it's saying, hey, okay, the more that things fall apart, you know, slowly, not a complete collapse, but as the more things fall apart, the closer we are to the end of the hiking cycle. And the closer we are to the end of the hiking cycle, then we can now look through a decline in earnings or decline in EPS and look to things starting to turn up as the Fed pauses and as global liquidity continues to pick up and they actually reverse at some point. So the market's going to look way far ahead. And that's kind of the point he's making there, is it's doing good. The market is grinding higher off bad news so far. That could change, but so far it's grinding higher off bad news because, you know, bad news means good news. It means the Fed will, you know, turn around. So let's keep going here.
are still up over where they were 2 years ago. Part of this is what people call an earnings recession, is just because earnings were so good last year. The market's up 8% year to date. Now we've had 2 consecutive quarters of gains. It's never happened in a bear market since 1950s. The bearish narrative isn't playing out because the market, again.
Okay, that's a big one. The markets never went up this long and ended in a bear market. So that's just statistics. You don't have to, you know, you could always play with statistics. I like Tom Lee, but that could be easily disproven because you can always cherry pick statistics. So is that hard evidence? No, but it is a sign of confidence. So I'd say that's a good sign of confidence that we're continuously grind higher, but it's not hard evidence yet.
Posted 2 consecutive quarters of gains, and it's up 8% year to date. Based on like real time, not statistically lagged CPI, the Fed has achieved its targets. I think what it comes down to is the Fed going to tolerate?
Okay, based on real time CPI, that's a big one. It's not included in this, but again, what is the market so worried about? The market is worried about the rate of core inflation, right? That's the biggest issue, core inflation. Well, real-time data tells us, the Redfin and Zillow rents tell us inflation is declining fast. Even the Case-Shiller home price index has declined so much. It's down back to 0. So we're not seeing inflation in housing. It's just not happening, right? It's not happening. The prices are climbing slowly in some states and they're falling in other states. So we're getting that rolling recession happening. And so he's saying if you look at real-time CPI, or by the time the Fed's shelter measurement comes in, inflation is going to drop really fast. Now, the counter to that is oil prices have came up, but we just saw that oil got rejected by 83.50, and it's actually making new lows from where it gapped up. So hey, that is starting to shift. As long as we have oil coming down, that CPI print from shelter is going to come in super weak at some point, and that is very bullish for the market.
Financial conditions easing. They're going to allow financial conditions to ease if they think that the risks are shifting. The shift in the conversation is now increasingly the risks of doing too much are equal or now greater than doing too little, which means the Fed could tolerate inflation not getting down to 2% if they think that there's enough progress being made.
The Fed is expecting this big.
Okay, so that's that's an argument there is, well, does the Fed really want to see, are they going to keep hiking until they get 2%? He's calling the bluff and saying, no, they just want inflation to continuously trend lower, right? And get under Fed funds rate. And they're not going to risk blowing up the entire economy. Now, yes, have they saved some of the banks? Yes, but they can't just print unlimited. They can't just blow everything up. And then, they're smart enough to know they're smart enough to know they can't blow everything up and then just save it, right? And then just come in and print liquidity. They're going to blow some stuff up, but for the most part, they can pull their hand off the trigger of rate hikes. And we already saw Fed Bostic from Atlanta say, hey, my projection is one more rate hike. and we pause. So that's what the market's looking at. One more rate hike, and we pause and we wait and we see, all these other stuff, all this other stuff popping up out of the economy. We're going to see how that goes. And then we'll wait and see from there. So again, it's just the story of the end of the rate hiking cycle and the turning of global liquidity and then positioning offsides. That's pretty much what we're seeing here.
Prices to lead to a mild recession.
This would put a ceiling on where rates end up peaking, and that's actually what's important to markets. Inflation's actually
Okay, another big one. Recession, right? The deeper we fall, this is about bond yields. The deeper we fall into recession or slowing growth. So as those, let's say earning, this is why I think it's really hard to make a super bear case like to new lows, because even if earnings are worse than expected and growth continues to slow, guess what comes down? Bond yields. Bond yields decelerate, and as bond yields decelerate, that's going to ease the market, because rates come down. Those are the rate. That's the cost of capital. Bond yields are the cost of capital for the market, and as long as those ease, then the market's going to say, oh, okay, valuations are better, earnings are coming down. So right away, valuations improve, and at the same time, when bond yields fall, guess what else falls? The dollar. So if the dollar breaks to new lows, that's going to, that's another risk on signal. So it's really hard to think we're making new lows. That's my biggest argument, or my biggest conviction, is where the lows are in. Can we grind sideways? Yes, that is still on the table. We could grind sideways for the rest of the year and, just consolidate between 4,200. I think it's more likely we break out, because I think inflation's a bigger deal coming down, a bigger deal than people think. I think it's not as sticky as people think. I think it's going to collapse eventually when shelter comes down. And I think the Fed's going to have to pause eventually, because they're going to see progress on inflation, and the market's going to love that and rip higher. So that's my thing. But we could move sideways. But new lows, very unlikely that we see new lows with the evidence we're seeing right now.
Undershoot faster, and we're seeing a lot of progress, and that's why Fed funds are coming down, and then the markets can rally.
Okay, so the markets can rally as long as Fed funds comes down. I think that's pretty true. You can't really argue that. So we got also breadth surge, bottoming signal. That's just another bottoming signal. We talked about that in the past. So let's move on to something else, or take a small break. Hold on, let me see. Oh, there we go. That's what I wanted to mention before we get off of here. Before we end it, is pretty much the technicals. Let's go over the technicals. This is a little easier, or a way to just look at the market and see what's about to happen. Okay. We went through a lot of data, but the technicals are going to tell us what's happening beforehand. So let me switch this up. All right, so YouTube, we're going to go through technicals and kind of go over the biggest risks, and we're going to end it right there. So stay tuned, and stay tuned so we can see how that actually works when it comes to the dollar, when it comes to interest rates, how those things are going to affect the market in real time versus some of the data we're seeing, because the market's a forward-looking mechanism. Okay, there we go. Let's get to the charts. Let's see these charts before we end. And if you want to see these charts, if you're on TikTok, you can quickly just go to my bio, click on YouTube, jump on the live stream, so you can actually see what I'm looking at here when it comes to the charts. And what I'm going to do is switch over to, we have them up? Yeah, we do have them up. Okay. Not this chart. We're going to go to we want to see the trading view, because it's a little easier to navigate on there. Let's get there. There it is. Okay. All right, we can see that. All right, and I'm going to switch you guys here so you can see it on TikTok. All right, so this is the dollar. All right, so this is the dollar. I just want to make sure you guys can see that too. All right, so basically, One of the principles is when the dollar moves up, that is a risk off signal. The dollar moving up is a risk off signal. And so far the dollar's been trending lower. And this is one thing that I'm keeping in mind is if we break below 100 and we're trending lower, if we get below that, that's a risk on signal. Investors are basically saying, hey, dump cash, get into equities, risk on. That's a risk on signal because obviously there's something in the market that are most of the risks in the market are dissipating and they're betting it goes up. If we shoot up from here, if we move higher and we get over 106, which is this level, then I'm going to be more risk off. I think my thesis is over. And, we do make new lows if the dollar gets above 106. But there's a plethora of variables, not just the dollar over 106. I also would have to see bond yields. We'll go to 10-year, making new highs. So if we get bond yields coming up and ripping, this is a 10-year above 4%, I think we're making new lows. Okay. If we get oil, and so far oil is working out for us, but if we get oil, crude oil, and look at that rejection, that's a beautiful rejection. If we get crude oil and we came up and retested the highs, it got rejected. I told we talked about this multiple times, is it has to get above 85. Just don't take that price cut. And I'm sorry, the production cut from OPEC as oil is going to 100. It doesn't work that way. Demand is falling and they know that. That's why they cut production. So oil is falling. That's a variable. That's a good variable because that means inflation is going to come right back down. This drop right here is the reason why we get such a big downside print in inflation. So maybe this month, this next month is going to be a little stickier when it comes to energy because we had that big surge. But if we come down, that eases things up. Now, next, this is a huge one that nobody's really you see it all over the news. But look at volatility. Volatility is suppressed, right? Volatility is making new lows all the way back to January, actually November. We got down to November of 2021. So what's up with that deal? Why is volatility so low? Do we come back up? Sure, we come back up and we retest. If is there any real risks? But the point is when volatility gets suppressed and it falls below 18, and when it holds below 18, that is a sign that we're headed back into a bull market. So keep your eye on volatility. Also, this is NASDAQ volatility. It's falling apart. NASDAQ volatility is absolutely falling apart. It's just trending lower. And every time we get that, the NASDAQ rips. Or it doesn't rip, but it's starting to grind back up either way. All right. So we have those charts, and then we have the MOVE index. Now this is bond volatility. It's a lot more volatile than the actual market. So this one's trending lower. That's good. That's another risk on signal because US Treasuries are not at risk. And as long as US Treasuries, there's no volatility there, then there's going to be risk taking in the equity market. Triple B spreads, right? This is one, these are new to a lot of people, but this is basically corporate versus US Treasuries. So if it goes up, there's a flight out of corporate bonds because people believe, oh my gosh, financial crisis. We can't hold equity debt because equities could default, but it's trending lower. So the trend lower is telling us, nope, there's still risk taking happening in the equity market. So that's another signal right there. So before we end things, before we get out, I will answer some questions if you guys have some questions on the TikTok. But before we get out, I just want you guys to keep in mind that liquidity is the tide that lifts all boats. And we're seeing liquidity in fiscal. We're seeing liquidity in China coming into the market, into capital markets. And as long as the Fed is going to save, the banking crisis, as long as they're going to backstop the banking crisis, then the market can move higher off that because it's not seeing a collapse in growth. As long as inflation trends lower, the market can keep moving higher. So right now, we're looking at earnings. Can they be better than expected? We don't know. We're going to keep our eye on Apple, Amazon, Microsoft, Tesla already reported. Now, is there room to come, all the way back down? Sure. But that's usually how bear markets end. We trend sideways for a while, and then we finally break out. So what is the catalyst that gets us above 420? What is that catalyst? I think that catalyst will be the Fed pausing and inflation finally dropping below Fed funds. And so the next question is, well, does it, okay, that happens and everybody's argument is growth will collapse. Well, hey, we got fiscal stimulus and we got global liquidity coming into the market. So any questions? I know that was a lot of information there. If you're just joining, You probably missed a lot of context, but we just wanted to. We're doing the YouTube. A lot of the charts are going to be on YouTube. We're going to be streaming on YouTube, and pretty soon we will have it hooked up to TikTok. But right now we're trying to figure out the technology so we can get that going. We'll get it going eventually. But yeah, any questions on there? If you guys are just joining, please hit the likes. If you have not already, I appreciate you guys paying attention. I know that was a lot. This is our first time doing the YouTube stream because it's a lot easier to show the stream, to actually show the charts and go through things in real time versus TikTok. So if you don't mind me just talking or listening, that's cool. But if you want to see the charts, subscribe to the YouTube channel. It's in the bio. And if you want to subscribe to any of my newsletters that come out, there's a free version, a paid version. The free stuff we're going to be doing throughout the week, just new data that comes out or new thesis, new sentiment that comes out. Go in the bio and you guys can, I think you get a 30-day free trial if you want. And that's just, a lot of my thoughts on what's actually changing in the market when it comes to technicals, when it comes to the macro, when it comes to commentators, what is changing, what is the macro looking like? And, to inform your trading or your investing. That's all it is for, is to inform me, because there's a lot of, I don't want to just say misinformation, but there's a lot of, missing pieces. And, overall, I think my thesis is, hey, the bear market is over and the bottom is in, and it's time to start thinking what could really squeeze these guys that are short. You got a 12-year record high of short positioning. What is going to squeeze them and change the dynamics of the market? So that's what I want you guys to know before we click out. If you guys ain't got nothing else, then I will catch you guys later. Appreciate you guys joining the stream, and have a good day.